If I told you there was a way to invest in a cash flowing asset, write off 90% of the cost in the first year and get all of your money back at the end of 5 years, you'd probably say, all right, man, what's the catch? Because let's be real, if it was that easy, we'd all be sitting on a yacht sipping margaritas right now. Most people think that you need a business to get big tax write-offs. But what if I told you that if you are a business owner or a W-2, that you can get a significant tax write-off if you follow the playbook that I'm going to lay out before you, but there are some rules and some criteria that you must follow. So in this video, I'm going to show you exactly how to structure this type of tax strategy, how I'm personally use it, and how business owners can leverage this tax strategy to reduce their tax bill, increase their cash flow, and ultimately generate another source of income. Let's get it. What's going on, everybody? Brian Rivera here, CPA, and I want to welcome you back to the channel. So on this channel, I talk about a lot of different topics to include business, CFO strategy, tax planning, tax strategy, all that good stuff. So if you are brand new, don't forget to hit that like and subscribe. And if you've been around for a while, appreciate the support. So I'm fortunate enough to do a lot of outreach. So I get to do paid consultations. I talk to many different business owners in the online space, in the real estate world, in the day trading world, high paid consultants, doctors, physicians, all that good stuff. But one of the commonality that all of these people share in common is that they are always looking for ways to invest and grow their wealth while reducing their taxable income. So what's the challenge? Most passive investments, quote unquote passive investments, require too much time. Real estate is a good option that I always encourage clients to do, but that's not everyone's cup of tea. Not everyone enjoys dealing with tenants who forgot to pay rent again. You know, people don't want to deal with tenants, toilets, and trash. So if that's you, you know, you automatically are going to strike out this type of tax play. Stocks, now that's not everyone's cup of tea, but thankfully I've been able to generate some income from the stock market, which actually fueled other investments. If you're not familiar with the market and you can't stomach volatility, you know, you really don't want to be playing in that space without the right education. So let's just hope that you don't tie your retirement fund to the latest meme stock. In taxes, Uncle Sam is always lurking, ready to take his cut, whether you like it or not. So what's the opportunity? Instead of just trying to write off expenses, business owners can turn these expenses into an investment. So by structuring an equipment leasing business, business owners can leverage financing using other people's money or the bank, earn cash flow, and write off the entire investment in the first year using depreciation. Now, equipment assets are leased directly to end users, or you can do it directly through a third-party rental platform, which allows you to generate monthly payments to offset the debt and provide a return on equity. So on average, the yield that I've seen through third-party platforms can range somewhere between 13 to 20% annually. So to drive this point home, let's look at a simple example so you guys can follow so you can see exactly how something like this could work and really impact your taxes. Now, let's just say you're a business owner in California and you're earning $1 million of net income per year on your taxes, and you're looking for a way to reduce your tax burden while creating another income source. Here's how it works. You invest $100,000 as your initial down payment to buy a piece or many pieces of high-end equipment. Now, you're going to finance 90% of the cost through an LLC using a commercial loan. And normally these loans are going to be a 10-year AM with a 5-year balloon payment. Now, the cash flow that the rental income covers is going to cover your loan payments and provides an additional cash flow of somewhere between 13 to 20% for the first 5 years. And if you're paying cash or you're renting on your own, these numbers are going to be different. Now let's look at the first year tax savings. So remember, you're $1 million business owner and you live in California. So the purchase price of your assets is $1 million. Your depreciation deduction, we're going to use Section 179. You can also use bonus, but it really depends on kind of what's going on with the tax rules and how high your income is. But at $1 million, Section 179 does make a lot of sense. And so looking at the federal tax savings, if your effective rate is 37% federal, that's going to be $370,000 in taxes on the federal side. And in California, the top tax rate is 13.3%. So that's another $133,000. So your total year one tax, quote unquote, burden is $503,000. So right away, we've been able to lower your taxable income by $1 million, and we've saved you about $503,000 in taxes which is 5 times more than the amount of your initial down payment. Now, at year 5, you're going to have 2 options. Number 1 is going to be sell the equipment to a buyer at market value. Normally, that's going to range 60 to 70% of the value of the equipment, which allows you to recoup 100% of your investment to pay off your loan balance. And then you're also going to recoup your $100,000 investment to get the loan. Now, since you wrote off the full cost of the equipment in the first year, any gains from that sale will be subject to what's called depreciation recapture. You can use that return of your down payment to offset that depreciation recapture tax, or you can keep going and buy additional equipment, which then will offset the depreciation recapture tax. Your second option is, instead of selling the equipment, you can exercise a buyout option to pay the loan off, and you can continue renting it out for additional profits. Now let's look at the full tax benefit of using this type of tax play. So in year 1, you're going to take 100% tax deduction on the full equipment cost using Section 179. You can also use bonus depreciation, but it all depends on how the rules are playing out in that particular year. But by leveraging depreciation, you're immediately reducing your taxable income. So what's the bottom line? You put in $100,000, you get all that back in 5 years. You earn $15,000 to $18,000 per year in income from renting that out. That's on top of your debt. And you significantly lowered your tax bill in the first year. And this is exactly why this is my number 1 tax play for this year. Now, before you get up and try to execute something like this from someone that you watched on YouTube, let's go through some of the common mistakes, and let's also give you a blueprint of how you can actually set something like this up. Mistake number 1 is thinking that equipment is just an expense. So if you're out here thinking equipment is just a cost, that's like thinking gym memberships just make you fit just by owning the membership. You got to actually use it the right way for it to make sense. So mistake number 2 is not structuring ownership correctly. So you wouldn't buy a rental property in your name, your personal name, at least I hope you wouldn't. So don't buy your equipment under your main business. You want to keep it separate. LLCs exist for a reason. Mistake number 3 is going to be not meeting the IRS material participation rules. So if you don't hear anything else I say today, this is the most important. If you think the IRS is just handing out deductions, you got to think again. You need to prove that you're actively involved and you're not just watching rental checks come in while you're scrolling the gram. Mistake number 4 is not understanding the risks of taking out commercial debt. Yes, financing is great, but if you don't understand commercial debt, commercial loans, it's like borrowing money in Vegas. It's fun at first, but it's brutal if you don't have a plan to pay it back. So if this sounds like a strategy that you would like to use, but you aren't sure how to set it up, my team helps business owners, CPA firms, W-2 owners, all those types of people think through and plan different tax saving strategies. So I'll drop a link of where you can reach out to our team. But stick with me because I'm breaking down exactly how this works, including how to meet the IRS material participation rules. So step number 1 in implementing this strategy is you need to set up your equipment rental LLC. So you want to form a separate LLC that will own and lease this equipment. This keeps liability separate from your name. It keeps it separate from your main businesses. So step number 2 is you're going to identify a banking partner that will finance equipment to you. You're going to finance that equipment using minimal cash down, usually 10%, using OPM or other people's money, which is just like the bank is leveraging your deposits. This time, you're leveraging it for the purpose of your tax strategy. So you want to identify high in-demand equipment categories, whether that's construction, transportation, medical, etc. I personally like the construction industry, and that's something that a lot of our clients have done as well. You're going to finance 80 to 90% of the purchase price through equipment lenders. We've had clients who actually couldn't qualify for equipment financing, but they did have cash. So what they did is they purchased that equipment all in cash, get the tax write-off, and then they do a refinance, usually after 2 to 3 years, of where most banks will allow you to do an asset-based refinance where you can take out 80% if you don't want to keep your cash tied up in those equipment assets. Step number 3 is you want to make sure you meet the IRS material participation rules, and I'll drop a link of exactly where those are. But what you want to do is the IRS needs to see that you're actively involved. So no forwarding one email to your CPA, that does not count. You need to keep detailed records of your involvement. That's emails, that's equipment, that's maintenance records, that's financial oversight. You can even conduct quarterly reviews of rental activity, pricing, and cash flow. You're going to oversee financing decisions because you're getting that debt, and then you're going to do cash flow projections to document your material participation. Usually what I found is that most people can meet the 100-hour test. That means you're spending 100 hours more than anybody else inside of this business. Step number 4 is now it's time to rent it out. So you're going to rent that equipment for income, and you're going to partner with rental platforms or industry-specific leasing networks that manage these rentals. You're going to collect that monthly rental income that covers your loan payments, plus a little bit of return on your initial equity investment. Now, step number 5, this is probably equally as important as material participation, but this is going to be maximizing your tax benefits. So the IRS wants you to reinvest in the economy. That's why there's Section 179. That's why there's bonus depreciation. So you want to take advantage of this while you can. Section 179 deduction, this is you're writing off the full cost of the equipment in year 1. There is limitations on that. And then bonus depreciation, depending on the year and depending on the administration, those rates fluctuate. But when it's most favorable, you can play with either one to make sure that it fits your personal tax situation. Now, with bonus depreciation, you can accelerate deductions to further reduce taxable income. You're also going to have interest deductions because you have commercial debt on the equipment. The loan interest on your equipment also qualifies as being tax deductible, and that's going to be netted against your rental income. Step number 6 is you want to reinvest in scale. Once your first equipment rental is running profitably, use that cash flow generated from year 1 tax savings to acquire more equipment and scale the actual strategy. Or you can redeploy that capital into your business to continue scaling. So what a lot of our clients do is they take that newfound tax savings and they use that and redeploy that into marketing, paid advertising, hiring new employees, hiring a CFO, hiring a tax firm. There's so many different things that you can do to reinvest in your business to ultimately scale your main business. All right, guys. So that is my number 1 tax play for this year. So if you want a CFO level strategy tailored to your business, my team at Hourglass Advisors helps business owners structure tax strategies just like this while optimizing tax savings. We also look at your business finances. We optimize your KPIs. We help making sure your accounting records are completely dialed in. Click the link below to apply. And also, if you found this video helpful, if you found this strategy helpful, hit that like button, subscribe for more CFO level insights, and comment below if you've ever considered leasing out equipment instead of renting it from someone else. Have a good one.